Amidst the snowy peaks of Davos, Switzerland, a clear warning echoed from the World Economic Forum. The annual gathering, set against the dramatic alpine landscape, is more than just a meeting of the world's most powerful leaders. It's a stage where the future of the global economy is debated and shaped. This year, the stakes felt higher than ever, as uncertainty and tension loomed over the international community. On January 20, 2026, François Villeroy de Galhau, governor of the French central bank, took the spotlight. He cautioned that new US trade tariffs could seriously hinder global economic growth, sending ripples of concern through the halls of the summit. His words were not just a prediction, but a call to action for policymakers and business leaders alike.
My message was one of sober realism. In our interconnected world, economic actions rarely happen in isolation. Every policy decision, especially those as significant as tariffs, can trigger a chain reaction that affects jobs, prices, and stability far beyond national borders. We must recognize the shared responsibility we have in maintaining a healthy global economy.
Davos is where leaders confront the realities of a tightly woven global economy. Here, the consequences of protectionism and isolationism are not just theoretical, they are felt in real time as nations and industries grapple with the fallout of policy shifts.
Tariffs are a lose-lose proposition. They may seem like a quick fix, but in reality, they spark retaliation, disrupt supply chains, and erode trust between trading partners. They harm everyone, including the country imposing them. Consumers face higher prices, businesses struggle with uncertainty, and workers risk losing their livelihoods as markets contract. Instead of boosting growth, they create friction, lower output, and slow investment. The ripple effects can be seen in declining factory activity, shrinking exports, and nervous investors pulling back from new ventures.
Drawing on recent history, Villeroy de Galhau pointed to last year's tariffs as a cautionary tale. The lessons are clear. Protectionist measures may offer short-term political gains, but they come at a steep, long-term cost to prosperity and cooperation. As leaders gather in the Alps, the perils of protectionism demand their full attention. The world is watching, hoping that wisdom and collaboration will prevail over division and short-sightedness.
So, what are tariffs? Simply put, they're taxes on imported goods. The goal is to make foreign products more expensive, encouraging people to buy local. For example, a 10% tariff on a German car in the UK raises its price, and that cost is passed to the buyer.
Tariffs come in many forms, fixed fees or percentages, but the effect is the same. They disrupt trade.
Governments use tariffs to protect industries, raise revenue, or as political leverage. But when one country imposes tariffs, others often retaliate, sparking trade wars. This tit-for-tat cycle disrupts business and creates uncertainty for companies relying on global markets. The impact ripples through the economy, raising costs for businesses and consumers alike.
Understanding tariffs is key to grasping why they threaten global growth. Villeroy de Galhau's point is clear. Tariffs hurt everyone, not just the countries they're aimed at. The effects ripple far beyond the initial targets, touching businesses, workers, and families in ways that aren't always obvious at first glance.
When the US slaps tariffs on European steel, it's not just foreign companies that feel the impact. American manufacturers who rely on imported steel suddenly face higher costs, which they often pass on to consumers. Everyday people notice the difference when they shop for cars, appliances, or even basic home goods. Prices climb and budgets get tighter.
Prices rise for cars, appliances, and more, leaving families with less to spend elsewhere. This squeeze on household budgets means people cut back on other purchases, which can hurt local businesses and slow economic growth in entire communities.
The policy meant to protect jobs can actually slow the whole economy. As costs rise and demand falls, factories may reduce shifts or even close, and small businesses struggle to stay afloat.
Retaliation is almost certain. Trade partners rarely sit back. They respond with their own tariffs, escalating the conflict and deepening the economic pain on both sides. Europe would hit back with tariffs on American goods, targeting industries from agriculture to manufacturing, and making it harder for US companies to compete abroad.
American farmers and manufacturers lose sales abroad, risking layoffs and lost investments. Rural communities and industrial towns can be hit especially hard, with fewer jobs and shrinking opportunities.
The very workers tariffs aim to help may see neighbors lose jobs in other sectors. The pain spreads, affecting entire regions and making recovery even more difficult.
The global economy is a web. Disruptions spread quickly, making goods pricier and industries less efficient. What starts as a single policy decision can trigger a chain reaction across continents.
Tariffs often create more problems than they solve, undermining the benefits of open trade. Instead of protecting jobs, they can stifle innovation and limit choices for everyone.
In the end, everyone feels the pinch, businesses, workers, and families alike. The costs of trade wars are real, and they're paid by people everywhere, every day.
The 2025 tariffs offer a real-world lesson in protectionism's effects.
When the US imposed tariffs on European goods, many feared a spike in European inflation. But the impact was minimal, because the cost was passed to American importers and consumers.
A French handbag's price didn't drop. American buyers simply paid more.
The burden of tariffs often falls on the importing country's consumers, not the exporters.
The US collected tariff revenue, but it came from its own citizens' pockets.
This contradicts the idea that tariffs make other countries pay. For Europe, inflation wasn't the issue. But for the US, tariffs became a domestic tax.
The lesson: tariffs act more as a tax on your own people than a weapon against rivals.
Tariffs are often sold as penalties for foreign rivals, but the real cost lands at home. While they are intended to protect domestic industries, the reality is far more complex and often detrimental to the very people they aim to help.
The 2025 tariffs showed that consumers and businesses in the imposing country pay most of the price. Higher costs for imported goods translate directly into higher prices for everyday items, affecting the average consumer's wallet.
Take German kitchen knives. If the US adds a 25% tariff, importers and retailers pass that cost to American shoppers. This means that a knife that once cost $100 now costs $125, making it less affordable for the average household.
The final buyer pays more, and this pattern repeats across thousands of products. From electronics to clothing, the added costs accumulate, leading to a noticeable impact on the cost of living.
Tariffs act as a regressive tax, hitting lower-income families hardest. These families spend a larger portion of their income on necessities, so price increases are felt more acutely.
Domestic businesses relying on imported parts also suffer, facing higher costs and reduced competitiveness. This can lead to higher prices for their products, making them less attractive in both domestic and international markets.
Sometimes, tariffs meant to protect one industry end up hurting others, forcing layoffs or price hikes. The ripple effect can be devastating, leading to job losses and economic downturns in sectors that were not the original targets of the tariffs.
The price of protectionism is paid by ordinary people and businesses far from the policy's target. The intended benefits often fail to materialize, leaving a trail of economic hardship in their wake.
In the end, trade barriers rarely deliver the promised benefits. Instead, they create a complex web of economic challenges that affect everyone, from consumers to business owners, making it clear that the true cost of trade barriers is far-reaching and profound.
Tariffs don't just raise prices, they slow the entire economic engine.
Free trade lets businesses plan, invest, and grow with confidence.
Tariffs inject uncertainty, making companies hesitate to invest or expand.
A sudden tariff can kill a major project overnight, costing jobs and growth.
This chilling effect on investment is one of protectionism's most damaging legacies.
Small businesses are hit too. Higher costs can force them to shrink or close.
Multiply this across the economy and growth stalls.
Tariffs also reduce the pressure on domestic firms to innovate, making them less competitive over time.
Open trade drives progress. Tariffs risk stagnation.
Today's products are built on global supply chains, a delicate dance of parts and expertise.
A smartphone's components come from all over the world before assembly and sale.
This system delivers better, cheaper products to consumers everywhere.
Tariffs are roadblocks, disrupting these intricate supply chains.
For a car maker, a tariff on one part can force costly, time-consuming changes.
Rebuilding supply chains is expensive and can take years, hurting quality and competitiveness.
The efficiency gains of global trade are lost, dragging down growth.
Ultimately, the country imposing tariffs risks making its own industries less competitive.
Damaging supply chains means falling behind in the global race for innovation. Tariffs directly raise the cost of living. Prices go up at the checkout.
Tariff costs are passed down the supply chain, landing on the final price tag.
This is cost-push inflation. Prices rise not from demand but from policy.
The 2025 tariffs didn't spike European inflation, but they did raise US prices.
If tariffs spread to more goods, families will feel the squeeze in their weekly shopping.
Central banks face a dilemma: fight tariff-driven inflation by raising interest rates.
Higher rates mean more expensive loans and mortgages, slowing the economy further.
Consumers are hit twice: higher prices and higher borrowing costs.
The policy meant to protect ends up hurting the very people it's supposed to help. The message from Davos is clear: trade barriers are a risky, blunt tool.
Tariffs may seem politically tempting, but they often backfire, hurting consumers and businesses at home. The 2025 tariffs proved the burden falls on domestic shoppers, fueling inflation and forcing tough choices for central banks.
Trade wars create uncertainty, chill investment, and disrupt the supply chains that power modern economies.
Policymakers face a choice: protectionism and stagnation, or cooperation and growth.
Open dialogue and negotiation, not punitive tariffs, offer a better path.
The global economy thrives on open, predictable trade. The warning from Davos is not political, but economic. Prosperity is built on bridges, not walls.
Responsible leadership means weighing these consequences and choosing sustainable growth for all.